What is good, trading family? Futures are green, my phone's buzzing pre-market, and the Nikkei just caught a rocket ship. I'm Wildcard. This is the trading floor. And if you're staring at yesterday's red stain and thinking the scare is over, you're missing the whole macro movie. TB, you got a disclaimer, and then the real opening act. Oil just did something that changes the near-term math, and most people haven't lived past Micron.
Standard disclaimer. This is two people talking about markets, not telling you what to do with your money. Do your own work. Now the tape, S&P futures are green, Qs are green, the VIX is pulling back from its spike. But underneath the bounce, the dollar is sitting at levels we haven't seen since November. And overnight West Texas Intermediate crude dropped to $69. That's the canary. The market is making two completely contradictory bets. And that tension is what we're going to pull apart all show. I'm opening with oil because it's the macro bomb that reframes everything, including tomorrow's PCE.
Fire it up. What happened in the Strait of Hormuz?
72 ships and 20 million barrels of crude moved through the strait in 24 hours. That is not a trickle, it's a flood. Physical supply that was being choked by the Iran proxy risk just hit the market, and West Texas Intermediate crude erased every dollar of war premium back to 69 pre-conflict levels. Iran's still lobbing mine threats and designated passage language, so headline risk is alive, but the physical reality is structural. The market just recalibrated supply expectations, and that is a disinflationary sledgehammer heading straight into tomorrow's PCE print.
Which is wild, because oil collapsing should be telling the Fed, hey, inflation's cooling, you can chill. But the dollar is at highs since November. That's the bond market, pricing a hawkish surprise anyway. So, we got cheap crude arguing for a dovish landing and a strong dollar screaming the opposite. That contradiction is the whole thread today.
Exactly. And I want to hang a trade on it right now. If we get an Iran headline, a mine incident, or a tanker threat that bounces West Texas Intermediate crude toward 72, I'd treat every dollar of that bounce as a short opportunity. The physical overhang is real, the bounce is noise. The structural trend is lower crude, and that feeds the soft inflation narrative, unless tomorrow's data blows it up. But before we get to PCE, you've got a stock that just printed margins nobody believed. What happened with Micron?
Bro, Micron didn't just beat. They put a flag in the ground. 85% gross margin. Let that sit. A memory chip company just ran margins at software company levels. Intel's best quarters top out around 60. TSMC runs 50 to 55. Micron just flexed 85. That means memory is no longer a commodity. The hyperscalers are paying whatever it takes because the artificial intelligence build-out is not optional for them. They cannot stop. Revenue guide is 49 to 51 billion. Fundamentally, that's the most terrifyingly bullish signal I've seen in semis.
And terrifying is the right word. 85% margins are an endpoint signal. It means the hyperscalers have zero pricing leverage. They'd rather overpay than fall behind. That's not a normal equilibrium, it's an unsustainable gold rush. The Bloomberg MLIV piece called this the volatile end phase of the artificial intelligence capex bubble, pointing to a 6-month cycle starting in May that runs through year-end. Every earnings report is now a prove-it-or-die moment.
100%. Micron passed the test, but the Korea flash crash yesterday tells us someone out there is levered the wrong way in this very trade. That KOSPI move was not about Micron. It happened before the print. Which brings us to the third story, Korea whiplash and TV. You said this is more than just noise.
KOSP. I dropped 10% yesterday, and as of this morning, it is up 5.4%. But that bounce doesn't come close to fully recovering the loss. The index still sits well below pre-crash levels. That move had a fundamental catalyst. It was sparked by panic selling linked to a broader tech rout in the US Qs down 3.2%, and a synchronized crypto sell-off. Something broke in Korea's market plumbing. Most likely, it was algorithmic cascades hitting a levered family office. A margin call blowup in thin overnight liquidity. The fact that it erased completely tells you it was a mechanical event, not a sentiment shift. And mechanical crashes are scarier than fundamental ones because they mean risk management somewhere just failed.
And if that exact same cascade hits ES futures at 3 a.m. Eastern when liquidity is vapor, someone's account gets obliterated before the coffee's even brewed. The KOSP. Snapback confirms the crash wasn't about Micron, but the yellow flag is flying. Retail takeaway. Check your stops, respect your position size, and don't sleep on the low liquidity hours. That was the dress rehearsal.
Which takes us to the main event. Tomorrow is a data dump. Second estimate GDP, durable goods, and the big one, core PCE. JP Morgan put out a year-end target of 7,800 on the S&P alongside an explicit flash crash warning. And MarketWatch ran a piece flagging hidden triggers and market complacency on rate hike risk. The dollar at November highs is telling you the bond boys already smell a hawkish surprise. But oil's crash is arguing the opposite. Tomorrow forces a resolution.
And that's the segment. If core PCE month-over-month prints below consensus, say 0.2 or softer, all of a sudden the disinflation story is real. That dollar has to drop, and the risk on rally can broaden. If it prints hot, 0.4 or higher, the dollar rips, the JP Morgan flash crash scenario kicks, and all those levered artificial intelligence positions start unwinding violently. The market is asleep at the wheel on that second scenario, and that's the honest sell-side note. We'll hit the exact consensus numbers in the calendar segment, but the stakes are sky high. Quick check on earnings. Beyond Micron, anything popping this week?
It's quiet. No other notable reports or guidance updates. We won't manufacture coverage. So let's go straight to the calendar. Friday's the big one. We get core PCE month over month, consensus at 0.3% versus a prior of 0.2. That's the cleanest inflation read. GDP second estimate, consensus 1.6% up from 0.5 prior. Durable goods orders expected to crater to -5% after last month's blowout, 7.9%. That's a reversion, not a collapse. We also get personal income and a separate PCE price index broader read, but the headline is the core month over month. Saturday brings Michigan consumer sentiment and one-year inflation expectations, both flat versus prior. And Monday, Japan retail sales drop, giving us a read on domestic demand and any yen carry unwind implications.
So, Friday morning, we'll know if the contradiction cracks. Saturday, the consumer tells us if they believe it, and Monday, Asia tells us if the plumbing still works. Now let's talk sector rotation, because the market's already voting with its feet.
1 week sector leaders tell the story. XLU Utilities up 1.07%, XLV Healthcare up 0.27%, XLI Industrials up 0.2%. Those are the only green sectors. Laggards, XLB Materials down 2.96%, the energy sector, ETF, Energy Crush down 3.23%, and XLC Communication Services getting annihilated down 5.15%. This is classic risk-off hide. Nobody is rotating into energy ahead of PCE. The energy sector, ETF, has been down 6 of the last 7 days. And with crude at 69, the sector is pricing in a demand slowdown, not a dip buy.
And XLC? Getting smoked aligns with the year-long giveback in comm services. The market is shedding anything that looks like growth risk. This rotation isn't a rotation. It's a retreat. Money's hiding in utilities. That tells you nobody is confident this bounce sticks.
Internationally, Asia tells the same mixed story. Nikkei up 4.61%, KOS, PI up 5.42%, massive bounces but off extreme fear. Hang Seng, though, down 1.43%. China weakness is real. Property fears, consumption softness, that's the soft spot in the global picture. Europe is flat, DAX up 0.59, FTSE up 0.23, Euro Stoxx 50 up 0.67. On the FX side, USD JPY is effectively flat after yesterday's spike, but DXY is still sitting near November highs, even with a tiny minus 0.15% on the session. That strong dollar is the macro plumbing. It pressures multinational earnings, tightens financial conditions, and makes EM debt more expensive.
And if PCE surprises hot tomorrow, that dollar rips higher and the carry trade unwind risk stops being dormant. For now, the yen is stable, but the fuse is still lit. The whole world is waiting on one inflation print.
Which makes the dollar contradiction the hottest theme touching our book right now. Let's go deep. Here's the through line. We have a strong dollar at November highs, a collapsing oil price that is deeply disinflationary, and an AI-driven tech rally that is pricing perfection. Those three things cannot coexist forever. And tomorrow's PCE forces the resolution. If core PCE comes in soft, say 0.2 or below, the disinflation thesis gets validated. The dollar drops, rate hike expectations evaporate, and you get an immaculate disinflation rally, risk on broadens, commodities and EM catch a bid, tech extends, everything works. That's the bull case, and it's the one the market seems positioned for.
But the dark timeline. And this is where the JP Morgan flash crash warning lands. is if core PCE surprises hot, a 0.4 print or higher. Suddenly, the dollar spikes, financial conditions tighten fast, and all those levered positions in the crowded artificial intelligence trade get margin called in low liquidity hours. Korea was the dress rehearsal. That kind of cascade becomes a 3 a.m. ES futures event, and the second order effects get ugly. A dollar spike crushes oil even further. Good for consumers, terrible for energy stocks. And it makes EM debt pricier, tightening global conditions just as the Fed watches sticky services inflation that doesn't care about cheap crude.
That's why I cut the energy sector ETF this morning. The wave trader Algo exited the long, the oil thesis broke. 72 ships and 20 million barrels proved the peace trade overshoot argument was dead. My paper account is still holding BYD, small underwater, but I like the long-term battery and clean energy story, so I'm letting that breathe. But I am not adding to anything ahead of tomorrow. If West Texas Intermediate crude bounces to 72 on an Iran mine headline, my gut call account will short crude into PCE. I think that bounce is a fade.
And I'm holding cash. The TFT algo got stopped out of Micron yesterday, so my main book is flat. My paper account is sitting at $9,891 and change, just watching. I'm not deploying a single dollar until the PCE prints. The gut call play I've got circled is the same as yours. If West Texas Intermediate crude spikes on a scare, I'm fading it at 72, but I'm not pulling the trigger. Pre-show. The smartest trade today might be patience.
That's the position. The dollar is priced for a hawkish surprise. Oil is priced for disinflation. Tech is priced for perfection. Tomorrow, the data picks which one was wrong, and we'll know the answer by Saturday.
So here's what we're watching tomorrow. 1. The core PCE month-over-month print. If it prints above 0.3, the dollar rips and the flash crash probability jumps hard. 2. West Texas Intermediate crude reaction. If it bounces to 72 on any Iran headline, our gut books are fading that short. 3. KOSP eye-opening. Did Korea actually stabilize, or was today a dead cat bounce that rolls over in Asian hours? 4. Micron follow-through. Does the semi-rally hold into the weekend, or does muscle memory fade the close? That's the show. Stay nimble, keep your stops tight, and we'll see you back here tomorrow to find out which side of the contradiction cracked. I'm Wildcard. He's TB, and this was the Trading Floor. Peace out.